I want you to think back to 2008. Remember the movie The Big Short? Remember that scene where Christian Bale is sitting alone in his office, listening to heavy metal music, looking at numbers on a screen that nobody else is looking at? He saw something that the rest of the world was blind to. He saw a housing market that was built on fraud, leverage, and lies. Everyone else was partying, buying second homes, and believing that prices could only go up. But he knew the math. He knew that beneath the surface, the foundation was rotten. He bet against the entire system. He was ridiculed. He was laughed at. He was threatened by his own investors. But he was right. And when the house of cards finally collapsed, he made a fortune while the rest of the world lost everything. We are standing in that exact same moment right now. But the asset class isn't housing. It isn't subprime mortgages. It is silver. There is a massive systemic disconnect in the silver market that rivals the housing bubble of 2008 in its scale and deception. On one side, we have the paper market, the futures contracts, the derivatives, the digital promises that trade billions of ounces a day without a single barm moving an inch. This market is telling you that silver is plentiful, that the price is contained, that everything is fine. On the other side, we have the physical market, the mines, the refineries, the industrial users. This market is screaming emergency. It is screaming that the vaults are empty, that production is falling, and that demand is exploding. These two realities cannot coexist forever. The tension is building. The fault line is cracking. And we are about to witness the greatest short squeeze in the history of commodities. Today, we are going to look at the numbers that the mainstream media is ignoring. We are going to look at the supply deficit that is mathematically impossible to fix in the short term. We are going to look at the inelastic demand from the AI and green energy revolutions that is devouring every ounce of metal that comes out of the ground. And we are going to talk about how you can position yourself for this trade of a lifetime. This is not about gambling. This is about seeing the train coming before it hits you. This is about understanding that the price on your screen is a lie and the metal in your hand is the truth. Let's start by dissecting the mechanism of the lie. The silver market is unique because it is effectively two different markets pretending to be one. You have the speedboat and the cargo ship. The speedboat is the paper market. It is fast, it is agile, and it is driven by speculation. Hedge funds, algorithms, and banks trade paper silver back and forth thousands of times a second. They can create supply out of thin air by issuing new contracts. If the price goes up too fast, they can short sell 1 billion ounces of paper silver in a microsecond to smash the price back down. This creates the illusion of liquidity. It creates the illusion that there is an infinite amount of silver available at the current price. But then there is the cargo ship. This is the physical market. It is slow to turn. It is heavy. It deals with real atoms, real mining trucks, real shipping containers. The cargo ship cannot turn on a dime. It cannot print more silver. It takes 10 years to find, permit, and build a new mine. It takes massive amounts of diesel fuel and labor to dig the rock out of the ground. The cargo ship is currently heading straight for an iceberg called structural deficit, and the speedboat is doing donuts around it, pretending everything is fine. The core of the problem lies in the supply side. Most people assume that if the price of silver goes up, miners will just mine more silver. That is how it works for oil, right? That is how it works for corn. But silver is different. Over 70% of the world's silver comes as a byproduct. It is an accident of geology. Miners are digging for copper to build the electric grid. They are digging for zinc to galvanize steel. They are digging for lead for batteries. And sometimes they find a little bit of silver mixed in with the other metals. This means that the supply of silver is not determined by the price of silver. It is determined by the demand for copper and zinc. If the global economy slows down and we need less copper, the supply of silver drops, even if the price of silver is going to the moon. This is called inelastic supply. The miners cannot respond to the price signal. They are handcuffed by geology. We are currently seeing a decline in or grades across the world. The easy silver has been mined. We are having to dig deeper, process more rock, and use more energy to get the same amount of metal. This is the definition of peak silver. We are running harder just to stay in the same place. Now, let's look at the demand side. This is where the story gets truly terrifying for the shorts. For decades, silver demand was driven by photography and jewelry. Photography went digital, and silver demand took a hit. But a new beast has awoken, a beast with an insatiable appetite. That beast is technology. We are in the early innings of two simultaneous revolutions: the green energy revolution and the artificial intelligence revolution. Both of these revolutions run on silver. Let's talk about AI. Everyone is talking about NVIDIA. Everyone is talking about ChatGPT. But they are forgetting the hardware. AI doesn't live in a cloud. It lives in massive data centers filled with thousands of high-performance chips. These chips generate immense heat. They require massive amounts of electricity. And they require the most efficient conductors known to man to move that data at the speed of light. Silver is the most conductive metal on the periodic table. It is better than copper. It is better than gold. You cannot build a high-performance AI chip without silver. You cannot build the 5G networks that connect them without silver. Then there is solar. Photovoltaic panels are consuming a larger and larger share of the global silver supply every year. The new generation of solar panels, Topkin and HJT cells, use significantly more silver than the old ones because they are more efficient. The world is racing to install solar capacity to meet climate goals. China is installing solar at a pace that is mind-boggling. India is following suit. This demand is inelastic. A solar manufacturer has invested billions in their factory. Silver is a small percentage of the cost of the panel, but it is essential. If silver goes from $30 to $100, they will still buy it. They have to. The alternative is shutting down the factory. So we have a supply that is stuck and falling, and a demand that is exploding and price insensitive. This is the formula for a super spike. It is the formula for a market that breaks. We are currently running a deficit of hundreds of millions of ounces a year. For the last few years, we have filled that gap by draining the above-ground stockpiles. We have drained the London vaults. We have drained the COMEX vaults. We are scraping the bottom of the barrel. This is where the big short analogy becomes real. The paper market is betting that the supply will always be there. They are shorting silver as if it is infinite. But the physical market is running dry. When the vaults hit zero, or effective zero, where the remaining metal is not for sale, the shorts are trapped. They will have to cover their positions. But who will sell to them? If there is no physical metal to back the contracts, the price has to go to infinity to force someone to sell their grandmother's tea set. This is the short squeeze. But it is not a squeeze orchestrated by a few guys on Reddit. It is a squeeze orchestrated by the laws of physics. It is the revenge of the real world against the financial world. We need to talk about the headline risk and how it plays into this. The world is becoming more dangerous. We have wars in Europe and the Middle East. We have trade wars between the US and China. We have political instability in South America. In times of chaos, capital seeks safety. It seeks assets that have no counterparty risk, assets that cannot be frozen, seized, or printed away. Gold is the primary beneficiary of this fear. But silver drafts behind gold. It is the high beta version of gold. When gold moves 1%, silver moves 2% or 3%. Currently, we are seeing a phenomenon where the silver price acts as a hybrid. When the economy is booming, silver rises because of industrial demand. When the economy is crashing or there is a war, silver rises because of safe haven demand. It is the only asset that wins in both scenarios. If we have a recession, the Fed will print money, which is good for silver. If we have a boom, industry needs more metal, which is good for silver. The only scenario where silver loses is a Goldilocks scenario of perfect stability, low inflation, and peace. Does that look like the world we live in? I want to address the flash crash phenomenon because you need to be mentally prepared for it. The paper market is still powerful. The banks can still smash the price in the short term. They can dump billions of dollars of paper silver on a Sunday night when liquidity is low to trigger stop losses. This is designed to shake you out. It is designed to make you panic. They want you to look at the chart, see a red candle, and sell your position. But here is the tell. Here is how you know it is a trick. Watch the premiums. If the spot price on your screen crashes by $2, but the price of a silver eagle at your local coin shop stays the same, or goes up, you know the crash is fake. The physical market is rejecting the paper price. This happened in 2020. Spot silver went to $12. But you couldn't buy an ounce of physical silver for less than $20 or $25. The paper market disconnected from reality. This divergence is the signal that the system is breaking. When you see a flash crash, do not panic. Ask yourself, did the supply of silver suddenly increase? Did a volcano erupt and spew silver bars? Did the solar industry decide to stop making panels? No, nothing changed in the real world. Only the paper world changed. That means the crash is a sale. It is a gift. It is a chance to accumulate more ounces for fewer dollars. This brings us to this strategy. How do you play this big short? You don't short the market like Christian Bale did. You go long the asset that is being suppressed. You buy the physical metal. This is the safest, most direct way to profit from the squeeze. When you hold the physical metal, you have removed the counterparty risk. You are not relying on a bank to honor a contract. You are not relying on a mining company to manage its costs. You hold the final settlement of the trade in your hand. But for those who want more leverage, for those who want to play the speedboat game with the knowledge of the cargo ship reality, there are the miners. Mining stocks are the leverage play. If silver goes up 50%, a good mining stock can go up 200% or 300%. Why? Because of operational leverage. Their costs are fixed. It costs the same amount of fuel and labor to dig the rock whether silver is $25 or $50. So every dollar increase in the price of silver goes straight to the bottom line profit. However, mining stocks are dangerous. They are volatile. They can go to zero if the mine floods or the government nationalizes it. You have to be selective. Stick to the producers. Stick to the companies that are actually pulling metal out of the ground today, not the ones promising to find it tomorrow. And diversify. Do not put all your eggs in one basket. The video mentions a portfolio approach. This is wisdom. You don't want to be 100% in silver. You want a balance. You want some growth, like tech/AI stocks, because that is where the innovation is. You want some value, dividend-paying stocks, for cash flow. And you want real assets, silver, gold, energy, for insurance and inflation protection. This barbell strategy protects you from all outcomes. If the tech boom continues, you win. If the dollar collapses, you win with silver. If the market goes sideways, you get dividends. But the big short thesis is specifically about the asymmetry of silver. The downside is limited. The cost of production is around $20 to $24 an ounce for many miners. The price cannot stay below the cost of production for long, or the mines shut down and supply vanishes, driving the price back up. So the floor is solid. But the ceiling? There is no ceiling. In a short squeeze, the price can go to any level necessary to force sellers to part with their metal. Could we see $100? Yes. Could we see $200? Yes. Adjusted for real inflation since 1980, silver should be well over $100 already. I want to talk about the psychological aspect of this trade. It is hard to be a contrarian. It is hard to hold an asset that everyone else ignores or ridicules. When Christian Bale was holding his short position, his own wife thought he was crazy. His investors sued him. He suffered immense stress. But he held on because he trusted his analysis. He trusted the math. You have to do the same. When silver is boring, when it goes sideways for months, you will be tempted to sell. You will look at your neighbor making money in crypto or tech stocks, and you will feel FOMO. But you have to remember the cargo ship. You have to remember the iceberg. The turn is coming. And when it comes, it will happen fast. It will happen overnight. You will wake up one morning and silver will be up $5. Then the next day, $10. And you won't be able to get back in. The dealers will be sold out. The phones will be ringing off the hook. This is why you have to position yourself before the event. You cannot wait for the headlines. By the time CNN is talking about the silver shortage, the move is over. The easy money has been made. You have to be early. Being early feels like being wrong, but it is the only way to be right when it matters. Let's go deeper into the paper versus physical divergence, because this is the mechanics of the explosion. The COMEX futures market operates on a fractional reserve system. For every ounce of physical silver in the registered vaults, there are hundreds of paper claims. This works as long as everyone is happy trading paper. It works as long as the traders are just betting on price direction and don't actually want the metal. But what happens when confidence breaks? What happens when a major player, a manufacturing giant, a sovereign wealth fund, a family office, decides they don't trust the paper? They stand for delivery. They say, I bought 5,000 ounces, bring it to my warehouse. When this happens, the leverage works in reverse. For every ounce that leaves the vault, hundreds of paper contracts become unbacked. The ratio of paper to physical explodes. This creates a run on the vault. It is just like a run on a bank. If everyone tries to withdraw their cash at once, the bank fails. If everyone tries to withdraw their silver at once, the COMEX fails. The exchange will have to declare force majeure. They will settle the contracts in cash. They will say, "Sorry, we don't have the silver. Here is a check for the last traded price." If you are holding a paper contract, you get a check, but you wanted silver. Now you take that check and try to buy physical silver in the open market. But there is none, or the price is double what the paper price was. You have been cashed out of your position right before the hyperinflationary spike. This is why physical possession is non-negotiable. If you don't hold it, you don't own it. You are just a creditor to a bankrupt system. The Big Short trade is not just about profit. It is about survival. We are witnessing the end of a 40-year cycle of falling interest rates and financialization. The pendulum is swinging back to hard assets. This cycle change will destroy trillions of dollars of paper wealth. Bonds, which were the safe asset for 40 years, are now the danger zone. Stocks, trading at historic valuations, are vulnerable to inflation and higher rates. Real estate is unaffordable. Where does the capital go? It has to go somewhere. It will flow into the things that cannot be printed. It will flow into the things that are essential for life and civilization. Food, energy, water, metals. Silver sits at the intersection of all these themes. It is money. It is energy, solar. It is technology. It is the ultimate doomsday prep asset that is also the ultimate future tech asset. Consider the China factor. China is stockpiling commodities. They are buying gold, copper, oil, and silver. They are preparing for a world where the dollar is weaponized or devalued. They know the math. They know the West is bankrupt. They are exchanging their trade surplus, the dollars they get from selling us plastic junk, for real resources. They are draining the West of its physical wealth. We are seeing silver flow from west to east, from the London vaults to the Shanghai vaults. Once it goes to Shanghai, it doesn't come back. It gets consumed by industry or locked away in strategic reserves. The West is losing pricing power. The price of silver will increasingly be set in Shanghai, not New York. And Shanghai wants higher prices to encourage more supply. New York wants lower prices to protect the dollar. This geopolitical tug-of-war will eventually snap the rope. And when the rope snaps, the price releases to the upside. Let's talk about the timetable. Everyone wants to know when. When will silver moon? The honest answer is, nobody knows. It could be next week. It could be next year. The system is resilient. The manipulators are skilled. They can kick the can down the road longer than you think. This is why you must have patience. This is why you must not use leverage. Leverage puts a time limit on your trade. If you are on margin, you can be right, but still get wiped out by volatility before the move happens. If you own physical, time is on your side. You are not paying interest. You are not subject to margin calls. You just wait. You let inflation do the work for you. You let the deficit do the work for you. Every day that passes, the deficit grows. Every day, the vaults get emptier. Every day, the pressure builds. It is a mathematical inevitability. Think about the New Deal for silver. We need a Green New Deal to save the planet, right? That is what the politicians say. Well, the Green New Deal is actually a Silver New Deal. You cannot have one without the other. If the governments of the world are serious about net zero 2050, they need to consume more silver in the next 20 years than has been mined in all of human history. Where is it going to come from? Recycling? Sure, we can recycle. But it is expensive and difficult to get silver out of electronics. Most of it ends up in landfills. It is lost. We consume silver like we consume oil. It gets used up. It gets dispersed. It is not like gold, which sits in a vault forever. Silver is an industrial consumable. We are burning through our inheritance. This scarcity mindset is what you need to adopt. Stop looking at silver as a chart. Look at it as a vanishing resource. Look at it like beachfront property. They aren't making any more of it. If you had the chance to buy beachfront property in Miami in 1950 for pennies, would you do it? Of course. Silver is the beachfront property of the 21st century economy. It is undervalued, underappreciated, and absolutely essential. The Big Short isn't just about betting against the housing market. It's about betting against the delusion of the crowd. The crowd believes that paper money has value. The crowd believes that resources are infinite. The crowd believes that the government can solve every problem by printing money. The crowd is wrong. And when the crowd is wrong on a massive scale, the opportunity for the contrarian is massive. You have the information. You have the data. You can see the supply cliff. You can see the demand explosion. You can see the paper manipulation. The question is, do you have the courage to act on it? Courage is not the absence of fear. Courage is acting in spite of fear. You will be scared when the price drops. You will be scared when the media tells you silver is dead. You will be scared when your friends laugh at you. But remember Christian Bale in that office. Remember the heavy metal music. Remember the conviction. He was alone, but he was right. You are not alone. There is a community of us who see the same thing. We are the silver stackers. We are the sound money advocates. We are the ones who are preparing for the inevitable correction of reality. So, here is your playbook. Get physical. Build a core position of physical metal that you hold outside the banking system. This is your insurance policy. Ignore the noise. Stop watching the minute-by-minute price. It is designed to trigger your emotions. Watch the fundamentals. Watch the inventory levels. Watch the mining production reports. Watch the spreads. The difference between spot and physical price is your real indicator. If spot drops, but premiums rise, buy more. Diversify. Don't bet the farm. Use a balanced approach. But make sure your allocation to real assets is significant enough to move the needle. Have patience. Rome wasn't built in a day, and the silver squeeze won't happen in an hour. It is a grinding war of attrition. But the shorts are running out of ammo, and we have all the time in the world. The big short trade of our generation is here. It is not in real estate. It is not in crypto. It is in the most undervalued, most essential, most manipulated asset on earth. It is in the shiny metal that powers our future. The gas gauge is broken. The engine is sputtering. The car is about to stop. But you are not in the car. You are watching from the side of the road, holding the only jerry can of fuel for miles. And when the driver gets out, desperate, willing to pay any price to get moving again, you will be the one setting the price. This is the asymmetry. This is the opportunity. This is the reality of silver in 2026. The world is waking up. The smart money is already moving. The dumb money is still chasing tech stocks at all-time highs. You have a window of time to position yourself before the herd stampedes. Don't waste it. Don't look back in 5 years and say, I knew it, but I didn't do anything. Regret is a terrible burden. Action is the cure. Take the red pill. Look at the real supply numbers. Look at the real demand numbers. Once you see it, you can't unsee it. The illusion of the paper market crumbles, and all that is left is the gleaming truth of the metal. The squeeze is coming. Are you ready?